Do you invest like Abhimanyu? Which means you know how to get in and when to get in, but have no clue of getting out. Welcome back to Wealth Waltz with Walunj, the show where you and I aim to waltz our way into the mysteries of building real wealth, one episode at a time. I'm your host Sandeep Walunj, man from Motilal, Oswal, and today we are going to be talking about something that nobody seems to discuss enough: when to exit an investment. Look around. Everyone from investment brands to advisors to social media influencers is screaming on the top of their voice, invest now, don't miss out. But when was the last time someone actually told you when to sell? Some experts actually tell you never to sell. So where does the truth lie? Well, as always, it lies in the middle, and let's break it down. There are some occasions when you ought to be thinking about selling. One such occasion is achievement of goals. Did you invest with a clear goal, like a retirement or buying a house or funding education? Then when your goal nears, there is no point gambling with your returns. You start shifting your money into safer assets. You wouldn't want to bet your dream home on a last minute market swing, would you? The second cue is profit booking. Let's not get too greedy. A stock might have doubled or tripled in value, and that feels good, but remember, unrealized gains are just a number on the screen until you cash out. You can use one of these tools to decide if it is time to book profits. The first one is the price to earnings multiple, or the PE ratio. If it is quite high compared to the historical averages, it could be a sign of overvaluation and a cue to sell. The second tool is the PB ratio, or the price to book ratio. If it is way above the intrinsic value, you might want to cash out. The third one is the DCF analysis, or discounted cash flow analysis. If your stock has hit its fair value, it could be time to exit. And oh please don't be one of those people holding on to stocks because of FOMO, fear of missing out. Locking in profits when you can could be smarter in the long run. The next one is a stop loss strategy. Ever held on to a sinking stock hoping that it could bounce back? A classic mistake. I cannot stress this one enough. A stop loss strategy sets a predetermined exit point to prevent bigger losses. Let's say you bought a stock at rupees 100 and set a 10% stop loss. So if the stock drops to 90, you must sell. This way, you are limiting your losses without the emotional stress of constantly checking the market. A stop loss strategy can save you from yourself. If a stock dips by 10 or 15% below your purchase price, exit before small losses turn into financial nightmare. So if your stock hits your stop loss, exit and move on. Don't keep waiting for a miracle. The next one is constant underperformance. If your investment has been consistently underperforming, despite of giving it ample time to recover, it probably is the time to get out. A hard look is warranted in the following cases. Is your mutual fund lagging behind its peers? Or if it is a stock, are the revenues and profits dipping? Is there a rising debt, or even worse, governance issues like fraud or regulatory troubles in your stock? Or is the company losing its leadership to its competitors? If these red flags show up, then stop and ask yourself, would I enter into this investment today? And if the answer is no, then it might be time to say goodbye. The next one is portfolio rebalance. A lot of people forget that investing is not just about picking winners, it is also about keeping your portfolio balanced. If one asset class, like say stocks, is dominating your portfolio and has grown too large, it's time to sell some off and invest it in other areas like bonds. You sure do not want to end up with a lopsided portfolio that could leave you exposed when things change. The next one are market and economic conditions. Ignoring macroeconomic trends is like selling blindfolded. Sometimes the economy itself might be giving you a signal that it's time to exit. Let's look at some of those indicators. The first factor is rising interest rates. Many sectors like real estate or capital intensive industries may underperform in this scenario, and you need to be careful. Second factor is recession indicators. An inverted yield curve or a declining consumer spending may warrant exiting cyclical stocks. Another major one is regulatory changes. New laws, tax policies, sectoral regulations can impact profitability. The biggest enemy in investing many times is not the market, it's your own mind. Let's talk about the psychological traps that keep you stuck. First up is loss aversion. You probably experienced this one. You bought an investment and now it is down, but rather than cutting your losses, you cling on to it hoping that it will turn around. It's the emotional sting of losses that makes us hold on longer than we should. But here is the thing, sometimes the smartest thing you can do is to let go. The next one is confirmation bias. You often are only looking for the good news and ignoring the red flags. Everything is fine, you think, as you tune out the warning lights. But ignoring the full picture can lead to big trouble when the market finally catches up with you. And then there is the anchoring bias. This is when you are fixated on the price you paid and refuse to sell even if the stock is much lower now. It is like you are holding on to a number instead of a strategy. But here is a secret. The price you paid doesn't matter now. What matters is the decision to sell that you probably are delaying. And that's a wrap on today's Wealth Waltz with Walunj. Smart investors know when to enter and when to exit. If you struggle with making these decisions, don't do it alone. Get some professional advice. If you enjoyed this episode, hit that subscribe button and comment with your doubts. I'll try to answer as many as possible. I'll see you next time as we keep waltzing towards smarter, wealthier investing. Catch you soon.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.